If you are within 3 years of retiring right now, I want you to pause for a moment and consider one important question. Do you know what your Social Security check is going to be on the first day you claim it? Not approximately, not what you expect it might be, but the exact number. The number that gets established permanently from that day forward and stays fixed regardless of what happens in the economy, regardless of what Congress does, regardless of how long you live. Most people within 3 years of retirement cannot answer that question with a specific number. They have a general sense of what to expect. They have a broad plan. Claim at 67 because that is the full retirement age, or claim early because there is no reason to wait. But here is what very few of them have actually done. They have never calculated the number that connects their Social Security claiming age to their IRA, their tax bracket, their required minimum distributions starting at 73, and their Medicare premiums. They have never seen those four systems analyzed together. They may have looked at each one individually at some point, but never together, never as one connected picture. And that complete picture is the only thing that shows you the true impact of your Social Security decision, not the break-even calculation, not the simple comparison of monthly checks, but the full picture across all four systems across 25 years of retirement. I have had more conversations with people approaching retirement in the past year about this specific topic than almost anything else, and the pattern is consistent. Someone is 6 months or 1 year away from retirement. They have made their Social Security decision. They feel settled about it. And then I walk them through the integrated projection, and something shifts in their expression, because for the first time, they are seeing what that decision actually means for them financially. Not just the monthly check amount, but the full impact across every tax return they will file for the rest of their life. This video is for anyone who is retiring in the next 3 years and has a traditional IRA. If that describes you, what you are about to learn may be among the most useful 30 minutes you spend in your retirement planning process. This video is for educational purposes only and is not tax or financial advice. Please consult a qualified tax professional before making any decisions about your specific situation. Every week, I break down the tax rules, the financial considerations, and the strategies that help retirees navigate the things that often go unexplained. If that is useful to you, consider subscribing and turning on notifications so you do not miss a video. Today, I am going to walk through what the 3 years before retirement look like from a tax and income planning perspective. Not from an investment perspective, not from a budgeting perspective, but from the perspective of the one decision that shapes your Social Security income, your IRA trajectory, your RMD burden, and your Medicare premiums for the rest of your life. And I am going to explain why the 3 years before you retire represent a valuable planning window that many people do not fully use. Let me start with the numbers that make this concrete. For anyone born in 1960 or later, the full retirement age for Social Security is 67. That is confirmed by the Social Security Administration. Claiming at 62 instead of 67 results in a permanent reduction of approximately 30%. Waiting from 67 to 70 earns delayed retirement credits of 8% per year, confirmed by the Social Security Administration for a total permanent increase of 24% above the full retirement age amount. What those percentages mean in real dollars. If your full retirement age benefit is $20,300 per month, claiming at 62 gives you approximately $1,610 per month. That is the number established permanently. Claiming at 67 gives you the full $2,300. Claiming at 70 gives you approximately $2,852 per month. The difference between claiming at 62 and claiming at 70 is approximately $1,242 every single month for the rest of your life, indexed to inflation through annual cost of living adjustments. Over 20 years, that difference represents approximately $298,000 in additional lifetime income, not counting inflation adjustments that increase it further every year. That is the figure that most break-even calculations do not fully account for. The fact that the cost of living adjustment applies to a larger base when you delay. So the gap between early claiming and delayed claiming grows every single year you are alive. But the Social Security benefit amount is not the only thing affected by when you claim, and this is where the 3 years before retirement become particularly important. When you retire but have not yet claimed Social Security, you enter what financial planners call the gap years. Your employment income has stopped. Your employer is no longer withholding taxes automatically from each paycheck. Social Security has not yet started. Your required minimum distributions have not yet begun because you are under age 73. For most people approaching retirement with meaningful traditional IRA balances, this gap period represents the lowest taxable income they will have for the rest of their retirement, and many of them do not take advantage of it. The gap years are the Roth conversion window, a period when you can move money from a traditional IRA to a Roth IRA at lower tax rates than you will face once Social Security income, required minimum distributions, and potentially pension income all combined simultaneously. Here's what the tax bracket opportunity looks like in 2026. A single filer in the gap years with no wages, no Social Security, and no RMDs has a standard deduction of $16,100, with the additional senior deduction of $2,050 for those 65 and older, and the senior bonus deduction of $6,000 under the One Big Beautiful Bill Act for those who qualify. A single filer over 65 can have approximately $24,150 in deductions before a dollar of taxable income is calculated. The 12% federal bracket runs through approximately $47,300 of taxable income. That means a single filer in the gap years can convert approximately $71,450 from a traditional IRA to a Roth at 12% or below. For a married couple both over 65 in the gap years, the combined deductions add up to approximately $47,500. That is the $30,200 standard deduction plus $3,300 from the existing age 65 additional deduction plus $12,000 from the senior bonus deduction. The 12% bracket runs through approximately $94,300 of taxable income. That means a married couple in the gap years can convert up to approximately $141,800 from a traditional IRA to Roth at 12% federal rates. Every dollar converted in those years at 12% federal rates is a dollar that will never generate a forced required minimum distribution. Every dollar converted is a dollar that will never push Social Security income into a higher taxable tier. Every dollar converted is a dollar that your heirs may eventually inherit tax-free instead of paying income tax on under the 10-year inherited IRA rule. And here is the timing point that many people overlook. If you are retiring in the next 3 years, your gap window is opening now, not when you retire. Right now, you can start modeling how many gap years you will have, what your income will look like in each of those years, and how much bracket space will be available for conversions each year. A person who plans the conversion strategy 2 years before retirement can sequence the first conversions in the calendar year they retire, when their earned income is partial year and the bracket space is substantial. Someone who discovers this concept at age 72, 1 year before required minimum distributions begin, has missed the window entirely. The brackets are already filled. The RMDs are determined by the traditional IRA balance that was never reduced. The Social Security taxability is set by the combined income level that was never adjusted. If the math I just described is prompting you to think about your own retirement timeline in a new way, please share this with anyone you know who is within 3 years of retiring and has a traditional IRA. Now, let me walk through the 4 systems that interact with the Social Security decision and explain why they need to be modeled together. System 1 is the Social Security benefit amount and the cost of living adjustment base. When you claim Social Security, you establish a base benefit. Every future cost of living adjustment is applied to that base. The 2026 COLA was 2.8%. A retiree who claims at 70 with a base benefit of $2,850 per month receives a cost of living adjustment applied to a larger base than a retiree who claimed at 67 with $2,300. Each year, the same COLA percentage produces a larger dollar increase for the delayed claimer because the percentage is applied to a higher starting number. Over 10, 15, and 20 years, those compounding differences mean the gap between the two checks widens every single year. The delayed claimer does not simply receive more money in the first month. The advantage grows continuously for as long as both retirees are alive. Before System 2, I want to address a specific situation that affects people who plan to work part-time after leaving their main job. If you claim Social Security before your full retirement age of 67 and you earn wages above the earnings test limit, the Social Security Administration reduces your benefit by $1 for every $2 you earn above $24,480 in 2026. In the year you reach your full retirement age, the reduction is more gradual, $1 for every $3 above $65,160. Once you reach full retirement age, the earnings test no longer applies. Here is why this matters for people planning part-time work in early retirement. A 63-year-old who retires from their main job claims Social Security immediately and then does consulting work earning $40,000 per year will have their benefit reduced by approximately $7,760 that year, half the difference between $40,000 and $24,480. The withheld benefits are eventually restored when you reach full retirement age, but the restoration happens gradually over several years and is not immediate. A more straightforward approach for anyone planning part-time work in early retirement is to delay claiming Social Security until the earnings test no longer applies. Use the gap years for Roth conversions using the bracket space created by lower income, and claim at the age that best fits both your earnings history and the tax interaction with your IRA. System 2 is the traditional IRA and the Roth conversion window. A person with a $550,000 traditional IRA who retires at 66 and claims Social Security at 70 has 4 gap years. If they convert $80,000 per year from the traditional IRA to Roth during those 4 years, they move $320,000 out of the traditional IRA at relatively low tax rates. Their traditional IRA at age 73, when required minimum distributions begin, is meaningfully smaller. Their RMDs are meaningfully lower. Their taxable income in their 70s, 80s, and 90s is lower because a large portion of their retirement assets now sits in a Roth that generates no required distributions. System 3 is the Social Security taxability interaction. The IRS calculates your combined income for Social Security taxation as your adjusted gross income plus any tax-exempt interest plus 50% of your Social Security benefits. For single filers, once combined income exceeds $34,000, up to 85% of your Social Security benefit becomes federally taxable ordinary income. For married couples filing jointly, the upper threshold is $44,000. A retiree who claims Social Security at 62 and simultaneously draws from a large traditional IRA has combined income that very likely puts 85% of their Social Security into the taxable range from the first year. A retiree who delayed Social Security to 70 and used the gap years to reduce their traditional IRA through Roth conversions arrives at age 70 with a higher Social Security benefit, but a smaller IRA and a Roth balance that generates zero combined income. Strategic use of the gap years reduces the portion of Social Security that is taxable, potentially saving meaningful amounts each year in federal taxes on income the retiree cannot otherwise control. Before System 4, I want to address the dimension of the Social Security decision that married couples most consistently underestimate. For a married couple, the higher earner's Social Security benefit becomes the survivor benefit when one spouse passes away. The surviving spouse keeps the higher of the two benefits permanently. The lower benefit ends. Only the higher one continues. This means the higher earner's decision about when to claim Social Security is not simply a personal income decision. It is the income foundation that the surviving spouse will live on potentially for decades. Consider a married couple where the higher earner has a full retirement age benefit of $2,500 per month and the lower earner has a benefit of $1,500 per month. If the higher earner claims at 62 and locks in a 30% reduction, their benefit is $1,150 per month. When the higher earner passes away, the survivor keeps $1,150. If instead the higher earner delays to 70, their benefit is $3,100 per month. When the higher earner passes away, the survivor keeps $3,100, a difference of $2,350 every single month for the rest of the survivor's life. A surviving spouse who lives 15 years after the higher earner's passing receives $243,000 more in lifetime income if the higher earner delayed to 70 versus claiming at 62. The decision that may have seemed personal was actually the most significant financial protection the higher earner could provide for their spouse. For married couples approaching retirement, modeling the survivor scenario is not optional. It is one of the most financially and emotionally important parts of the Social Security decision, and it is rarely included in the simple break-even calculation. System 4 is Medicare and the 2-year look-back. Medicare Part B premiums in 2026 are $185 per month at the standard level. The first IRMAA surcharge tier begins at $106,000 in modified adjusted gross income for single filers and $212,000 for married couples filing jointly. At those thresholds, the premium increases meaningfully. The surcharge is determined by your income from 2 years prior. A person approaching retirement who does a larger Roth conversions during the gap years needs to be aware that conversion amounts could push modified adjusted gross income above the IRMAA threshold 2 years before they go on Medicare. On the other side, someone who does no conversions and arrives at age 73 with large required minimum distributions may find that those mandatory distributions push them into IRMAA territory permanently, paying Medicare surcharges every year for the rest of their retirement on income they cannot reduce. Before the checklist, I want to address the most common concern I hear when I explain this framework to people approaching retirement. The concern is this: I cannot afford to delay Social Security because I will not have enough income to live on during the gap years without it. This is a real constraint for some people, and I want to address it honestly. For someone who genuinely does not have sufficient savings to cover living expenses during a gap period, delaying Social Security creates a real financial hardship, and claiming earlier may be the appropriate decision, regardless of the long-term math. But this video is specifically about traditional IRAs. If you have a traditional IRA with a meaningful balance, that IRA is the bridge asset that makes the strategy work. You withdraw what you need from the IRA to cover living expenses during the gap years. You also convert an additional amount from the IRA to Roth each year, the amount that fills your available bracket space. The IRA funds both your living expenses and your conversion strategy simultaneously. Someone with $300,000 in a traditional IRA who retires at 66 has enough of an asset base to cover 4 years of modest living expenses from the IRA while also completing meaningful Roth conversions each year. They do not need Social Security to get through the gap. They need to plan the IRA withdrawals carefully so they serve both purposes. The second concern I hear is about Social Security solvency. What if Social Security reduces benefits before age 70? The Social Security Trust Fund is projected to face a funding gap in the early to mid-2030s under current law. At that point, without congressional action, the program could pay approximately 79% of scheduled benefits. Even a proportional reduction would not eliminate the advantage of delaying, because it applies equally to all claimants. A retiree with a larger base from delaying to 70 still receives more after a proportional reduction than someone who locked in a 30% reduction at 62. And a retiree who used the gap years to build a meaningful Roth IRA is not relying on Social Security as their only income source. The Roth provides tax-free income that does not generate the combined income that makes Social Security taxation worse. Here is your pre-retirement action checklist. First, go to ssa.gov and log in or create your My Social Security account. Download your statement. Review your projected monthly benefit at age 62, 67, and 70. These are your starting numbers. The difference between the age 67 figure and the age 70 figure tells you exactly how much additional guaranteed permanent income you can establish by delaying 3 years. Second, calculate your gap years. Count from your planned retirement date to age 70. That is your Roth conversion window. If you plan to retire at 64, you have 6 gap years. If you retire at 66, you have 4. If you retire at 68, you have 2. Each year in that window is a year of bracket space that closes permanently when RMDs begin at 73. Third, estimate the bracket space available each year. Take your total deductions, standard deduction, any applicable senior deductions, any other adjustments, and subtract them from the top of the 12% bracket. What remains is the amount you can convert each year at 12% or below. For most people approaching retirement with no pension and no other significant income sources, this number is substantial. Fourth, project what your required minimum distributions will look like at age 73 under 2 scenarios. Scenario 1, no Roth conversions during the gap years, and the traditional IRA grows until RMDs begin. Scenario 2, strategic conversions reduce the traditional IRA balance meaningfully before RMDs begin. The difference in annual required taxable income between those 2 scenarios is the real cost of not using the gap years. Fifth, model the Social Security taxability in both scenarios at age 73. In Scenario 1, with larger RMDs, what percentage of Social Security is taxable? In Scenario 2, with smaller RMDs and a Roth balance generating 0 combined income, what percentage is taxable? The annual tax savings on Social Security income alone can be significant when combined income is meaningfully lower. Sixth, check the IRMAA threshold in each scenario. Does either scenario push modified adjusted gross income above $106,000 for single filers or $212,000 for married couples? If Scenario 1 does and Scenario 2 does not, the savings in Medicare premiums is an additional benefit of the conversion strategy. One more planning consideration that is specifically relevant for the years 2025 through 2028. The One Big Beautiful Bill Act created a temporary senior bonus deduction of $6,000 per person for taxpayers aged 65 and older. For a married couple both over 65, the deduction is $12,000 combined. The deduction is available whether you itemize or take the standard deduction. It phases out for single filers with modified adjusted gross income above $75,000 and for married couples above $150,000. It is available through tax year 2028 only. For people planning gap year Roth conversions, this deduction creates additional bracket space. A married couple, both over 65 in 2026, can stack the standard deduction of $30,200, the existing age 65 additional deduction of $3,300 for both spouses, and the senior bonus deduction of $12,000, a total of $47,500 in deductions before a dollar of taxable income is calculated. That is $47,500 worth of IRA balance that can be converted to Roth before the 12% bracket even begins. The senior bonus deduction expiring after 2028 means that for people who are 65 or older right now, the next 3 years offer more conversion capacity at lower rates than any 3-year window that follows. Someone who turns 65 in 2026 and plans to retire in 2028 has a window where the combined deductions are at their highest level, and that window closes after tax year 2028. Now let me walk through what the integrated projection actually looks like with specific numbers, so this is concrete. Consider someone who is 64 years old, planning to retire at 66, with a traditional IRA of $550,000 and a full retirement age benefit of $2,300 per month. 3 possible claiming ages: 62, 67, and 70. At 62, the permanent monthly benefit is approximately $1,610. At 67, it is $2,300. At 70, it is approximately $2,152. In the scenario where they claim at 62 and draw from the traditional IRA for living expenses with no Roth conversions, their combined income at age 73 will be relatively high because the IRA has not been reduced through conversions and the RMDs are larger. The lower Social Security benefit combined with larger RMDs pushes combined income above the $34,000 threshold, where 85% of Social Security becomes taxable. They are paying tax on a smaller benefit while the taxation applies to the maximum number of dollars. In the scenario where they retire at 66, complete 4 years of strategic Roth conversions within the 12% bracket, and claim Social Security at 70, the picture at age 73 is different across every dimension. Higher Social Security benefit, smaller traditional IRA, lower required minimum distributions, Roth balance generating zero combined income. The combination keeps combined income lower. Less Social Security is taxable. Medicare premiums remain at the standard rate rather than the IRMAA surcharge level. The tax advantage of Scenario 3 over Scenario 1, projected across 25 years, is meaningful. Not because of one single move, but because 4 systems that were each working against the retiree in Scenario 1 are all working for the retiree in Scenario 3. That is the picture most people approaching retirement have not yet seen, and the 3 years before retirement are the only remaining window to change which scenario they end up in. The 3 years before retirement are not a waiting period. They are the only window you will have to shape the financial systems that define your retirement income for the rest of your life. The Social Security decision, the Roth conversion opportunity, the RMD trajectory, the Medicare premium exposure, all of them are set in motion by the choices you make in this window. Once you retire and claim, the Social Security decision is permanent. Once RMDs begin at 73, the IRS establishes the minimum income you must take each year, whether you want it or not. The window does not reopen. There is one final thought I want to leave you with. The Social Security Administration does not notify you when your gap window opens. The IRS does not contact you when your bracket space is at its widest. Your IRA custodian does not flag the years when Roth conversions are most efficient. The Medicare system does not alert you when your projected RMDs will push you into IRMAA territory 2 years from now. All 4 of these systems operate on their own timelines. None of them pause for you to be ready. None of them remind you that the optimal planning window is narrowing. The entire responsibility for connecting them and acting within the window before it closes rests with you. The people who understand this framework and act on it in the 3 years before retirement arrive at age 70 in a meaningfully different financial position than those who do not. Not because they earned more during their careers, not because their investments performed better, but because they understood that the 3 years before retirement are not a waiting room. They are the last opportunity to shape the systems that will run automatically for the rest of their lives. If you are watching this video, you still have time to use that window. If this video helped you see a connection between your retirement timing and your IRA that you had not considered before, please share it with someone you know who is within 3 years of retiring. Let me know in the comments where you are right now. How many years away from retirement are you? Have you worked through the integrated Social Security projection yet? Or are you still using the simple break-even approach? Do you have a traditional IRA? And have you started thinking about how the gap years fit into your plan? Share your situation, your age, your timeline, your questions. I read every comment. The situations that come up most often become future videos, and if your question reflects something that many other people approaching retirement are also asking, I will make a video that addresses it directly. Subscribe to this channel for more practical retirement planning content.